Lending Club is a U.S. peer-to-peer lending company, headquartered in San Francisco, California. It was the first peer-to-peer lender to register its offerings as securities with the Securities and Exchange Commission, and to offer loan trading on a secondary market. Lending Club operates an online lending platform that enables borrowers to obtain a loan, and investors to purchase notes backed by payments made on loans. Lending Club is the world's largest peer-to-peer lending platform. As of June 30, 2015, the platform has originated $11.1 billion in loans. In August 2014, the firm filed with U.S. regulators for its IPO. On December 10, 2014, the company raised almost $900 million in the largest U.S. tech IPO of 2014. The stock soared 56% next day on its first day of trading, to $23.42 a share, valuing the company at $8.5 billion. History. Early history. Lending Club was initially launched on Facebook as one of Facebook's first applications. After receiving $10.26 million in a Series A funding round in August 2007, from venture capital investors Norist Venture Partners and Canaan Partners, Lending Club was developed into a full-scale peer-to-peer lending company. On April 8, 2008, Lending Club temporarily suspended new lender registration, cancelled its affiliate program and entered a quiet period while it awaited approval to issue promissory notes to lenders. On June 20, 2008, Lending Club filed an S-1 statement with the U.S. Securities and Exchange Commission seeking the registration of $600 million in member payment-dependent notes to be issued on its website. On August 1, 2008, Lending Club filed an amendment to its Form S-1 outlining new interest rate formulas as well as more details on a resale trading system. On October 14, 2008, Lending Club announced its completion of the SEC registration process, posted the filed prospectus on its website, and resumed new lender registration. Notes issued on or after October 14, 2008 represent Lending Club securities rather than direct obligations of the ultimate borrower and are tradable on the FolioFN trading platform. In March 2009, Lending Club raised $12 million in a Series B funding round led by Magenthala Ventures. 2010. In April 2010, the company raised $24.5 million in a Series C funding led by Foundation Capital and joined by existing investors including Magenthala Ventures, Norist Venture Partners and Canaan Partners. 2011. In August 2011, Lending Club raised an additional $25 million in venture capital from Union Square Ventures and Invest, owned by the Thompson family of Thomson Reuters. This led to Lending Club earning a $275 million post-money valuation and an increase of $80 million in valuation from the preceding year. Thomson Reuters founder Peter J. Thompson also invested an unspecified amount of his personal fortune into Lending Club. In fall 2011, Lending Club's headquarters moved to downtown San Francisco. Its earlier offices were located in Sunnyvale and Redwood City. Co-founder Sol Htite moved to China to start Dianrong.com, a peer-to-peer lending company based in Shanghai. 2012. In 2012, the company employed about 80 people, with Renaud Laplanche continuing as the company's CEO and chairman of the board of directors. The company averaged about $1.5 million in loan originations daily, with a total of $600 million since its founding. In April 2012, Lending Club's SEC registration from 2008 was renewed for $1 billion USD in member payment-dependent notes and became effective on April 10, 2012. In June 2012, the company received $15 million in new funding from Kleiner Perkins Caulfield and Byers and $2.5 million of personal investments from John J. Mack. Kleiner Perkins partner Mary Meeker joined Mack on Lending Club's board of directors. This led to a $570 million valuation of the company. In November 2012, Lending Club surpassed $1 billion in loans issued since inception and announced they were now cash flow positive. 2013. As of March 15, 2013, Lending Club had facilitated more than 100,000 loans, for a total of $1.5 billion. In May 2013, Google purchased a stake in Lending Club, leading to a valuation of $1.55 billion, which was nearly 3 times as much as the company was valued in June 2012. The investment by Google was part of a $125 million secondary round. As of this time, Lending Club was responsible for facilitating more than $1.9 billion loans in total. Lending Club also began partnering with smaller banks in order to help streamline their small loans operations. In June 2013, the company partnered with Titan Bank in Texas and Congressional Bank in Maryland in order to help them facilitate loans that would have been otherwise unprofitable for them. The company also prepared to be IPO ready in 2014. 2014 In March 2014, Lending Club began providing loans to small businesses. In April 2014, Lending Club acquired Springstone Financial. In May 2014, Lending Club formed a partnership with Union Bank. On August 27, 2014, Lending Club filed for an IPO with the SEC, the offering taking place in December 2014. 2015 LaPlanche told Forbes in April 2015 that Lending Club would expand into car loans and mortgages. Lending Club also announced a partnership with Google to extend credit to smaller companies that use Google's business services. The company signed partnerships with Google, Alibaba.com, Bank Alliance, and Home Advisor, including betting community bank lenders for Bank Alliance, in order to send people on its platform to various community finance institutions. That year, Lending Club partnered with Opportunity Fund, announced by former President Bill Clinton at the Clinton Global Initiative. The partnership intended to provide $10 million to small businesses in areas of California that are underserved by lenders. Lending Club and other small business lenders partnered with Sama unregistered trademark S Club to deliver its Early Business Lending Center Euro product. In August 2015, the company created Lending Club Open Integration. In October, the company launched a multi-draw line of credit product for small businesses. Business model. Overview. Lending Club enables borrowers to create loan listings on its website by supplying details about themselves and the loans that they would like to request. All loans are unsecured personal loans and can be between $1,000–$35,000. On the basis of the borrower unregistered trademark S credit score, credit history, desired loan amount and the borrower unregistered trademark S debt-to-income ratio, Lending Club determines whether the borrower is credit-worthy and assigns to its approved loans a credit grade that determines payable interest rate and fees. The standard loan period is 3 years. A 5-year period is available at a higher interest rate and additional fees. The loans can be repaid at any time without penalty. Only investors in 39 U.S. states are eligible to purchase notes on the Lending Club platform. However, eligibility differs when purchasing notes on the secondary market, Folio FN. Borrowers from all but 2 U.S. states are eligible to apply for a loan. Investors can search and browse the loan listings on Lending Club website and select loans that they want to invest in based on the information supplied about the borrower, amount of loan, loan grade, and loan purpose. The loans can only be chosen at the interest rates assigned by Lending Club, but investors can decide how much to fund each borrower, with the minimum investment of $25 per note. Investors make money from interest. Rates vary from 6.03% to 26.06%, depending on the credit grade assigned to the loan. Lending Club makes money by charging borrowers an origination fee and investors a service fee. The size of the origination fee depends on the credit grade and ranges to be 1.1%–5.0% of the loan amount. The size of the service fee is 1% on all amounts the borrower pays. The company facilitates interest rates that are better for lenders and borrowers than they would receive from most banks. It has averaged between a 6 and 9% return to investors between its founding and 2013. However, because lenders are making personal loans to individuals on the site, their gains are taxable as personal income instead of investment income. Therefore, Income from lending club loans may be taxed at a higher rate than investments that are taxed at the capital gains rate. Loan ownership equals, after the notes are issued, lending club purchases the loans from the issuing bank and notes become the obligations of lending club, and not of the ultimate borrower. Lending club promises to pay the note holder monies it receives from the borrower less its service fees, while the holders of lending club notes have the status of unsecured creditors of lending club. This means that there is a risk that the investor may lose all or part of the investment if lending club becomes insolvent or declares bankruptcy, even if the ultimate borrower continues to pay. The investors have the ability to put notes up for sale before the notes have reached maturity. This service is offered in a partnership with Foliofn Investments, which charges a 1% fee on note sales, making Lending Club the first peer-to-peer lending network to offer a secondary market for peer-to-peer loans. Other peer-to-peer lending networks have subsequently also partnered with Foliofn Investments to offer a secondary market. Credit risk equals, when initially founded, Lending Club positioned itself as a social networking service and set up opportunities for members to identify group affinities, based on a theory the borrowers would be less likely to default to lenders with whom they had affinities and social relationships. It developed an algorithm called Lending Match for identifying common relationship factors such as geographic location, educational and professional background, and connectedness within a given social network. After registering with the SEC, Lending Club stopped presenting itself as a social network and maintaining that social affinity will necessarily reduce the defaulting risk. It now presents the algorithm just as a search tool for investors to find notes they would like to purchase, using borrower and loan attributes such as the length of a loan term, target weighted average interest rate, borrower credit score, employment tenure, home ownership status, and others. To reduce default risk, Lending Club focuses on high credit-worthy borrowers, declining approximately 90% of the loan applications it receives and assigning higher interest rates to riskier borrowers within its credit criteria. Only borrowers with FICO score of 660 or higher can be approved for loans. Loan performance statistics equals, as of June 30, 2015, the average Lending Club borrower has a FICO score of 699, 17.7% debt-to-income ratio, 16.2 years of credit history, $73,945 of personal income, and takes out an average loan of $14,553 that he uses for debt consolidation or for paying off credit card debts. The investors had funded $11,217,348,156 in loans, with $1,911,759,192 coming from Q2 2015. The nominal average interest rate is 14.08%, default rate 3.39%, and an average net annualized return of 8.93%. The average returns of investment for Lending Club lenders are between 5.47% and 10.22%, with 23 straight quarters of positive returns as of the second quarter of 2013. Board of Directors: John Mack, Senior Advisor, Morgan Stanley; Mary Meeker, Partner, Kleiner Perkins Caulfield and Byers; Hans Morris, Advisory Director, General Atlantic; former President of Visa Incorporated, Lawrence H. Summers, Professor, Harvard University; Renaud Laplanche, CEO, Lending Club; Daniel T. Ciperin, General Partner, Canaan Partners; Jeff Crow, Managing Partner, Norist Venture Partners; Rebecca Lynn, Partner, Magenthala Ventures. Recognition: in 2011 and 2012 the company was named to as one of the Always On Global 250. Lending Club is the winner of the World Economic Forum 2012 Technology Pioneer Award. It has been recognized by Forbes as one of America Euro Unregistered Trademark's 20 Most Promising Companies in 2011 and 2012, and by Fast Company as one of the 10 Most Innovative Financial Companies in the world. It was named one of the Disruptor 50 by CNBC in May 2013 and 2014, as a disruptive innovator in next-generation financial services. See also, comparison of crowdfunding services, disintermediation. References. Further reading: Peter Renton, Renord Lapland, The Lending Club Story ISBN 978-1-48113-173-5. External links, Company website Lending Club official website.